Actually, when you throw more data in, it turns out that behind this noisy, cloudy horizon, there is another undiscovered continent, if you will. And that's known as the second descent. And traditionally, that wasn't in the statistics textbooks because you never got there. We didn't know it existed, except for some experimental researchers. But now, in terms of models, it means that more complexity actually eventually translates into an even lower error rate of your models.
Welcome back to Alpha Uncovered. My name is Alvin Fan, CEO of OPIM. Today, we are thrilled to welcome back a very special guest, Ivan Chelebiev, the visionary founder and head of investments at Chicago Global. Ivan is a maverick in the investment world and has been blending finance with cutting-edge machine learning technology. He's joining us here today in sunny Hong Kong to talk about AI, machine learning, and some of the recent developments that we've been seeing in the industry, and more importantly, how it affects investing at an institutional level. Please welcome Ivan Chelebiev. Ivan, welcome back. It's really good to see you again here in, overcast Hong Kong, but still sunny by most measures. It feels like ages ago because the world has changed again since we last sat down and talked. And just for those of us who are meeting you for the first time, maybe you can just give a quick introduction about yourself and what you do.
It's a pleasure to be here again, and thank you for inviting me back. My name is Ivan Chelebiev. I'm the CIO of Chicago Global. We're a Singapore-based asset manager or wealth tech company. As a lot of what we do is, in addition to managing portfolios for clients, we also develop models that we work with institutions to help them navigate this changing world.
Great. I want to sort of dive straight into the weeds a little bit to talk about AI. It's still the hottest topic, and it will be, I think, for the foreseeable future. In our last conversation, one of the takeaways was you were moving into research that was not just looking at large data sets globally, but you're actually getting to some very granular data, not just in the US and the large economies, but also into the emerging markets here in Asia, India, China. One of the takeaways was that part of your global strategy, the China book, was actually outperforming not just the China index, but most China managers, because the system was able to adapt and adjust to the market environment well before most managers did. So first of all, congratulations. Number two, it looks like in just a few short months, we've made additional progress, both in the hardware space. I think NVIDIA just released their announcement on their performance this year. I have yet to check it, but they have a history of beating analyst estimates. So here we are. So let me kick it off, or maybe you can kick it off. Give us a sense on where we are in the space right now. And from the perspective of a team like yourself, where you've been working in machine learning longer than even OpenAI to a great extent. And here we are moving into the generative evolution of AI. Walk us through what you're seeing in this space. And then number two, maybe an update on how you're applying those updates to your current models.
Yeah, so we started around the same time in 2015 as OpenAI. They've become very prominent. That's made it hard for them to keep their team together. Our team has stayed together. So in that sphere, to have a team stick around for 10 years as a cohesive unit is considered longevity. And this whole time, we've been trying to make our models more and more adaptive, starting out by thinking about investing as an information problem, and then using information technology to attack the problem. What's changed since then was, number one, the invention of transformers by a team at Google, and then NVIDIA's progress in terms of the hardware. So if you look at something like Moore's Law over the last 60 years, it has held up. But over the last decade, progress has been like 10 to 100 times faster than Moore's Law, if you look at the output. And that's because we've reinvented computing. Moore's Law was important as a measure of the density of transistors because hardware improvement was the key driver. Software was static. It was written by humans, and so improving that was very slow.
So is it fair to say that the software has always lagged hardware to that extent, and that has been sort of like a handicap on Moore's Law?
Well, Moore's Law just focuses on the hardware component, yes, and software was not considered a driver or a yardstick of progress because it was just moving much more slowly. And the key element was the hardware improving. Now we have accelerated computing. We have systems that are using graphics chips. So the hardware itself is moving much faster than the number of transistors you can pack. And on top of that, the software is written by AI. It's heavily machine learned, and in the future, that's going to become even more prominent. And so software is moving much faster. It's improving much faster. A lot of what's happened in our team over the last 10 years is building the AI that helps you to curate the data. So that AI itself is very complicated and takes a lot of work. And once you have it, then you can have much better data sets. And that allows you to then train other AI on top of that, which is used for security selection and just understanding what's happening in the world. So these things are layered on top of each other. And if you look at the growth curve, it's something that is moving much faster than Moore's law.
So when you look at growth curve, you're talking about growth as in computational output, qualitative output of computational power. When you say growth, how are we measuring that?
Inference, our ability to understand the world. So our focus has always been on something called nowcasting as opposed to forecasting. So these big moves, let's say what's happening in the White House, people are trying to first pick who is going to win the election and then what they're going to do. And we think it's very hard to get an edge in that. What we try to do instead is have a very big data funnel and understand what is happening in the world today. And from that, trying to predict where the world is going tomorrow. And then tomorrow we'll predict for the day after. So we move at much smaller increments with a greater level of precision, as opposed to trying to figure out what is going to happen when, let's say, Trump and Xi Jinping meet and what is going to be the outcome. I think it's very hard to predict that. So our focus was just getting more data, understanding what is happening, and making the models better able to adapt to what they're seeing.
So is that more like when you say nowcasting, it feels it's more about the term and the scope of the predictability. So instead of having very broad, longer term predictability, we're looking at more recency, I guess more real-time predictabilities. Is that a fair statement?
Yeah, we're trying to move, think about it like a 1980s Sony Trinitron, where it has a lot of color, but it's pixelated, to something that is 4K or 8K.
Right.
And so you need to get all the pixels in there. And then once you get the pixels, you need to then absorb and understand what you're looking at. Mm-hmm. So we analyze every publicly listed company in the world. It gives you a groundswell of information, and then to understand what it means. So one of the stories over the summer was the big moves in the Japanese yen. And what is the impact on companies that are export-oriented versus import-oriented? Again, speculating around the table gives you a big margin for error, whereas we just try to see what the companies themselves are doing and then adjust based on that information, as opposed to speculating and overlaying the stories.
So with Moore's law, you mentioned that we're now, I guess it would be at a different stage of development. So walk us through what that means. If growth now, or at least the rate of growth has changed, what does that mean now that we have the software now catching up to the hardware, as you say? This is particularly interesting. Two takeaways so far is one, the clarity of the results, or at least the output and the inference, is incredibly important for financial data and for investing. And it could be transformative for how we look at asset management. I think we're both on the same page there. Yeah. But let's go back to Moore's law and where we are in terms of the output metrics.
Yeah, so you have the efforts to pack more chips, more transistors are continuing, but at some point you get physical limits in terms of how many, you're talking about electrons. But on top of that, with graphics units, you can accelerate computing in a different way. And further from that, the AI can make the use of the hardware much more efficient.
Yep.
And finally, with more data, then you can get much better results. So this was a big factor in allowing the launch of the large language models by OpenAI. To apply to finance, the tolerance for error is much lower. So it took a lot of time to train the system and get it to a point where comfortable, instead of just using it in the lab on specific projects, to actually allow it to become more involved in the management of the portfolio. Human oversight still remains paramount. Mm-hmm. And machines can do a lot of good, they can do a lot of damage. They cannot be held accountable. So there is always a person who pulled the trigger or released an autonomous car on the street that needs to be held responsible. And so for us as fiduciaries, we ultimately are responsible to our investors for managing their assets. And so the bar is very high, and we're slowly finding various ways to unhobble the models and allow them to take advantage of all the gains in compute and all the data availability. And that has allowed us to build models that are much more adaptive.
Okay.
So as the world is changing and the meaning of different investment strategies, valuations, different factors is becoming harder and harder to follow, these models play an even more important role.
So you brought a slide today, so let's have a look at this. It's quite interesting for those listening on the podcast. We have a chart that's called the shift toward machine learning. It's about 3 sections on the chart. On the y-axis, we have MSE validation laws. Along the x-axis, it's epochs. Yeah. So translating that, if I understand this correctly, on the x-axis, we're talking about variables added over time. And then on the y-axis, it's the ability to explain, but it can also be interpreted as noise for any output over 1. So the scale goes from 1 up to 1.4 on the y, and then on the x-axis, it's variables of 10 to the power of 3. And then you have, I guess it would be 3 quadrants or 3 areas on the chart. There's the first descent, which is the first section of the graph. The second section is overfitting, where it scales up. And then the third is the second descent, where we see a very dramatic drop down. So yeah, Ivan, walk me through what I'm looking at here.
So traditionally, statisticians, when they run regressions, what they found is that you want to be parsimonious. You want to find 2, 3, 4, 5 variables that help you to reduce the model error. So as you add more variables, you go from 1 to 10, that's 10 to the first, your error drops down. As you keep adding more variables, you're just adding noise, because these new variables actually tend to capture, but in a more fuzzy, less precise manner, some of the things that the main variables already are capturing. So the model will look better and better within your sample, but when you take it out, you just have the noise will create worse results.
Got it.
So what we have been able to find since then is that actually when you throw more data in, it turns out that behind this noisy, cloudy horizon, there is another undiscovered continent, if you will. And that's known as the second descent. And traditionally, that wasn't in the statistics textbooks, because you never got there. We didn't know it existed, except for some experimental researchers. But now, in terms of models, it means that more complexity actually eventually translates into an even lower error rate of your models. So going from 5 variables to 100 actually gets you to this overfitting issue, but then eventually it's overcome as you get closer to 1,000 variables.
And it's overcoming that because of computational power or because we need more data?
The computational power just allows you to cross over the horizon and see what is possible. It was too expensive to get there, and it was only tried in experimental settings. Whereas now, this is something that can be used in practice.
So give me an example of what this means. Like, is it just what I'm seeing on a chat box that makes it so incredible? Because that's just the generative LLM side of the model. But what you're talking about is almost an increase in the resolution of the output. So number 1, how do you measure it? And number 2, give me an example of how I can observe that.
So it allows us to analyze a company within its context in terms of the industry, but also within the broader macroeconomic context. So let's say if you look at valuation metrics such as PE, and you have a few decades of data, it turns out that companies that are too expensive on a PE basis, on average, will underperform cheaper ones because you're buying high and you're selling low.
Yep.
However, when you're in a bull market or in a highly exuberant episode, the highest, most glamorous names will actually outperform until they crash.
That's right.
So understanding what era you're in allows you to then tweak the mix of variables that you're using to analyze a company. And so that is one example of what it allows you to do.
So just to put this in perspective, when we were looking at quant managers maybe 5, 6, 7 years ago, they would build models that were, as you say, fitted, overly or not is debatable, for a low interest rate environment, because most of the data has recency bias for the last, say, 10 years or more, which has been primarily a low interest rate environment. So the models themselves, and everyone knew, were not really well adapted to a shift. And we saw that in the collapse of a lot of quant managers that we saw here in Asia and even globally. And so the problem was garbage in, garbage out. They weren't able to adapt, and they knew that. So the fix or the plan B for that was to create a regime overlay. So this would be like a nerve center or an allocation model over the top, which would identify almost as a second model, which would identify shifts from one regime into the next. And then allocate from model A to model B. So model A would be low interest rate environment, model B would be high interest rate environment, and the overlay would modulate between the two. So that was the fix. So based on what you're saying, I guess the question is, how is it now different than, and what does it solve, since there was kind of a solution for that?
Yeah, so
Before.
we look at each company and say, okay, how will a human analyst build a dossier on this company? And we end up building one using around 100 different variables. So we look at governance metrics, the supply chain, the competitive nature, unit cost, and so on. And so we build this picture. But the meaning of each of these metrics changes based on the environment. And so we can interact every variable with a bunch of economic variables. And then we can be much more precise in giving them the right weight based on the regime that they're in. So if you, as you were saying, if you go back 30, 40 years, in the 80s, interest rates were very high. And so we've had this period of slowly declining interest rates with small wobbles here and there, which if you look at it on a long horizon, you can just write them out. And interest rates are coming down. Globalization is gradually increasing since the 90s. And so you have a particular type of company that is going to outperform, that's benefiting from. And then we hit 2020. You have trade war, you have deglobalization, nearshoring, you have inflation coming in with a lot of stimulus. And now the correlation between interest rates and valuations is no longer the same. And also that varies drastically from region to region. The dynamics in Japan, starting 3 years ago, were very different than what was happening in Europe or in the US or in China. And so being able to understand deeply the meaning of each of these metrics as opposed to mechanically ranking is a great advantage in navigating the world, a world which is changing so quickly.
It sounds like it's then taking on the position, because another solution was to have a human over the top who would look at multiple models. And as a human or as a CIO, I would not arbitrarily, but I would discretionarily decide how to allocate between one low interest rate type of model, one, say, long vol type of model, and another 3 different types of submodels that would be good for a certain regime. So what you're saying is now the models can take over that role as well by integrating them from the bottom up.
So they have a much longer memory. They can be much more objective interpreting the data than humans who tend to be influenced by what they read in the newspaper, by their peers. Each one of us considers themselves to be unique, original thinker, contrarian. And turns out that we are social animals and we tend to suffer from groupthink much more than we would ever acknowledge or suspect. So what happened in China with sort of the updrift of deflation and the downshifting growth, most investors continue to use the old playbook. And they thought, okay, I'm just buying the dip. Okay, I need to be more patient and it's going to come back. And actually, they should have been using a very different playbook. But last time that playbook was in use was in 2010 in Europe, and before that in Japan in the 90s, when the onset of deflation started in these places. But very few China-focused investors were doing a similar strategy in Japan 30 years prior to that. The models do it. And so they can pick up what this looks like, and then they can adjust to that regime.
Just going back to China, again, one of the takeaways from our last discussion was how, almost in hindsight, we realized that the models were outperforming. I think this is interesting because this is one of the, and I don't want to call it a black box, but one of the interesting aspects about AI and about machine learning is that because of how in real time the computation is happening so quickly and so fast, it takes a lot of time, it takes a little bit of time for us as humans to unwind the logic of how to approach that decision to invest or allocate or to divest from China or to switch from a large cap to a medium cap or from growth to cyclicals, as your models did in the last few years, and therefore extract alpha and outperform the index as a result, right? And so Monday morning quarterback, hindsight 2020, here we are today. Not only did we find that there's an outperformance, but seems like this has inspired the team to maybe take a more nuanced approach at covering emerging markets as well.
So to us, what happened in China is what we're trying to do in every other market all the time, and what it's designed to do. China stood out because other markets were doing relatively well, and China was different. And so we focused on that, and we saw that we've done quite well compared to the index. Then we spoke to our investors, and many of them had exposure to China through index funds, active funds, private equity or private capital funds, VC, and none of it had worked. So that's when we started thinking about it. And whenever the market peaked in China, there was no announcement, right? You end up sometime later and you look back, oh, that was the peak. Nowcasting doesn't need you to make this call. And so it's adjusting and adjusting and adjusting. And so, yeah, it's not clear what exactly the changes are. There's small changes. For humans, when you look back, then you say, okay, now we're in a downdraft or a bear market, and then you can switch. But by the time you make this call and then you commit to it psychologically, maybe the downdraft is ending. So this approach, being more objective, allows you to avoid falling into these narratives, which tend to be consensus-driven, and so it's hard to generate differentiated performance. When things are going in a uniform fashion around the world, it's less noticeable. So we noticed that in China, we started speaking with our investors, and then we looked at India, and India was a huge bull market at the same time. We had outperformed in India as well, and our performance in ASEAN, in parts of emerging Europe and Latin America was also very good. And these are generally considered emerging markets, but if you look at the emerging market index, it has failed abjectly to capture the growth of the underlying economies, which is designed to reflect. And so the MSCI Emerging Market Index over the last 20 years hasn't delivered anything similar to what you've seen in developed markets.
Yeah. It's ironic because emerging markets in the last 10 years have generated 70% of the global GDP and moving in an upward trajectory. All of that value seems to be captured in mature markets.
Yeah. And so we believe a big part of the reason was that the methodology is 50 years old, and the division into emerging and developed markets is 50 years old, and it's kind of stuck. And
sorry, when you say the model, meaning the financial model, or you mean the
MSCI's view, which reflected investor views of the world. You have the developed markets, and then you have these other markets that I can use to diversify. And in some cases, you can access this through an index because it's too hard, or you could get a specialized manager, but they're kind of a satellite. And maybe that was true in the 70s and 80s when these indices were designed. Yeah. Since then, they have become deeply ingrained in the way people think about investing and allocating across regions. And if you actually brush this off and you look at growth, you see that growth has been quite the opposite of the allocation of MSCI World. What MSCI tells you is the world is 66% North America. Yeah. And then if you add a few other large markets, they tend to be 70%. These markets are large in terms of market cap. They're also more liquid. They're cheaper to trade, and they're the most competitive markets in the world. So that is one reason to think about allocating to other markets. Also, it happens that our investors' own holdings are completely lopsided.
Yes.
So they're very heavy US tech, but they're actually short GDP growth. And we wanted to come out with a product that helps them to bring balance to their portfolios and gives them exposure to these markets that are very hard for our competitors to navigate because they're less deep, less liquid. But we're experts in navigating them, managing the volatility, hedging them. And so our approach to portfolio construction in China, India, and all these other markets is very different than the index.
So let me stop you there. It feels like the idea then, or at least the impetus, is to not take a contrarian approach, but to try to unlock value in what are inherently higher growth markets, but are handcuffed by capital markets dynamics, which are partly sentiment, investor habit, and legacy portfolio construction driven, whether it be, as you pointed out, MSCI, emerging markets, or Asia, for example, which are still heavily overweighted in one direction. And more importantly, home-based bias, where most institutional capital is being based, let alone the dominance of the US dollar, generally speaking, right? So my immediate gut reaction is, how are you going to unlock that value for something that, in terms of the entire game, is kind of stacked against emerging markets in the first place?
Yes, so it's an outdated worldview, so an outdated mindset, which translates into an outdated toolkit, skill set, and that makes it difficult to access. The results have been mediocre, and from our perspective, that is an opportunity. When we run our portfolio in the US, we're competing with the most sophisticated players in the world. Many of them have the same technology that we have, which is at the frontier. And some of them have much deeper pockets, larger teams. And it's good to have exposure to these markets because there is opportunity there. But when we invest in Brazil, we face very different competitors, much less sophisticated. And it's much easier to find and extract value there. So for instance, you have ASML, which is a very important company to AI, which is based in the Netherlands. And in Taiwan, you have TSMC. So a lot of managers will have the Magnificent Seven plus TSMC and ASML.
And they call themselves global.
Global, and they think that this is where the growth is and so on. These businesses are very well known. They're great businesses, but today they're trading at a huge premium to their historical valuation, to very optimistic expectations, which are built into the price. And we find that there are many other companies in Taiwan, in Europe, which have better fundamentals and give you exposure to the underlying growth. And when you put them together, you have a global portfolio, which is not developed versus undeveloped, because I don't think that Korea or Taiwan are less developed than Italy or Spain. So you can get the global diversification with new sources of deep alpha that's hidden in these corners, and you're facing much less sophisticated competitors. So all these things...
And to be fair, you're talking about finding alpha in these smaller emerging markets. We're not talking about extracting beta, which is primarily how most allocators are thinking. So, well, the beta there is kind of underwhelming, right?
Yeah.
But what you're saying is that you can extract uncorrelated alpha from these emerging markets in a more consistent manner.
Yep, that's right.
So talk me through Polaris,
Yeah.
which is your new strategy and approach to emerging markets.
Polaris is just taking these markets out of the main fund and offering them on a standalone basis. So that a big part of it will be China and India, which are at different points of the business cycle. So they have very nice correlation benefits. But then all these other markets. So Scandinavia has a very strong startup scene. Of course, Norway has fossil fuels. So does Saudi Arabia, United Arab Emirates, Kuwait. So we have exposure to these markets. Brazil, Australia. And then when you blend them with markets like Malaysia or Singapore or China, and you have something that is very global, that has incredible demographics, an emerging consumer class in many of these markets. Poland used to be a poor country on the periphery of Europe 30, 40 years ago. Today, it has surpassed Spain in terms of GDP per capita, and it's on path to surpass Germany. People still think of it as a peripheral European tiny outpost. It's actually smack in the center of Europe. And being between Germany and China, it can benefit from growth, innovation, and as a member of the European Union, tax benefits as well. So just being able to look there gives you a big advantage. And there are a lot of interesting companies that are geared to benefit from that.
Okay. I guess it would be similar to the global strategy where you're looking at not just top down, but very, very focused on bottom up. In fact, you're looking at company data, you're looking at some macro. One of the challenges that I hear constantly is how do you ensure data quality from these emerging markets? Because it may not be as ubiquitous or may not be as easily accessible from, say, developed markets. Is that true? Number one, is that true? And number two is, if so, how do you solve for it?
It's true for the, let's say, bottom half of each of these markets. The top half, which is larger, more established companies, have better quality data. And then a lot of the technology is actually forensic accounting. So we use things like information theory, which studies the way people cook the books.
Yeah.
Believe it or not, there are patterns when people falsify the numbers. So we look at these red flags and then we diversify. We expect to have larger rate of defaults and fraud, but oftentimes the bad players are actually easier to spot because there are issues with their boards, there are issues with litigation. Sometimes their reports will come late or be restated. So by looking at every company in each of these markets, we can spot the ones that are having problems. We have a very large opportunity set, so we can easily avoid them. So to us, it's not just 5 companies in Taiwan and 5 companies in Korea. We look at every company. And so if there's some issue with one of them, we're just going to move on to the next candidate. And then the discounts that they trade at more than compensate you for the risk. Because a lot of the risk is perception. And if you go and do the work, you can eliminate that and just focus on the ones that have actual problems and work to identify the issues, diversify them, and you can pick up this premium, which is a bias against these markets.
So let's walk through one example that I came across recently. I interviewed with a Korean manager, actually, that talked about the Korean discount. And the Korean discount is a result of something very unique in Seoul or in Korea, where the tribals control majority of the float in the stock. And so they're typically not friendly to minority investors. And a big part of the reason why there's a discount or a suppression in the price is because the tribals have to face an inheritance tax. And the inheritance tax calculation includes share price and appreciation. And so those capital gains feed into the calculation of the inheritance tax. So for most of these typically outstanding and fundamentally strong companies are faced with a massive discount, partly because of artificial suppression and also because some of that value is being extracted out in private subsidiaries or associate companies by the families themselves. Now, the government is trying to make attempts to improve on this and unlock that value. You're seeing an uplift in engagement and friendly engagement strategies there right now. So walk me through how your strategy or how your machine learning models looks at that data and is able to unlock it, where by and large the beta is very suppressed.
Yeah. So we found that there is something called a complexity premium. Businesses that are very complex have a lot of subsidiaries and offshore entities and so on tend to underperform. They usually tend to hide something. So think about Enron, GE, and the Chables definitely qualify there. If you are operating an index-based vehicle that's judged based on tracking error, you need to have a large part of your portfolio allocated to the largest companies in the market.
Yeah.
Just to minimize tracking error. Yeah. And those are going to be these companies, which were the giants over the last 50 years. We don't have that constraint. Our worldview or our investable universe in Korea is not limited to the index. We actually are index agnostic. So in terms of the number of listed companies, the chaebols make us a very small percentage. So we can go in and out of them from time to time, but they will never be a meaningful portion of our Korea book. So we look at them as other companies, and oftentimes, because of their complexity, they will have a lower ranking.
So I guess one question then comes to mind is why not go with the largest companies? I mean, if the game itself is rigged in that direction and you have better liquidity, even though you have great companies, it's hard to tell when the value of those underlying companies will be catalyzed into a markup or otherwise. So is there something that your model is doing to identify timing or to improve so that maybe it can time a markup? Or will it just hold onto undervalued companies for as long as it takes? Because I see a lot of even discretionary managers kind of suffer from holding on to fantastic companies, but don't see a markup because there's not the environment doesn't help them or the discount keeps the whole market underwater.
Yeah. So our system is called Parallax. Parallax is an astronomical tool that is used to ascertain the distance of a very remote object by looking at it from two different angles. And then you can measure the parallax. So for us, the two angles are the tactical and the fundamental. So we will look at the fundamentals and we want to find the discount to intrinsic value, but then we need to have a catalyst. And the catalyst is going to help you avoid sitting on something that is cheap for a very long time. And the catalyst can be related to change in the macro environment, a shift in industry dynamics because of innovation, because of sanctions, because of competition, because of internal regulatory antitrust activity, just a change in the corporate environment as we had in Japan, where people waited and tried in all kinds of ways to take a more active role to engage with management. And it just required 20 years. And then the climate changed and now management is way more receptive. Yeah. So we will analyze every company and then act only when the parallax tells us that there is this overlap between compelling fundamentals with something changing. So we looked at a lot of technical indicators that are similar to the way people stare at charts, except we use machine vision. And so that gives you a much more precise. Your eyes don't get tired. You don't get tricked by changes in scale. And you can literally compare every company's chart. And then we have a bunch of different ways to analyze the quality of the trend. So we want the trend to be there. We will look at changes in perceptions among analysts. So not just taking the consensus and looking for consensus that's improving, but we'll break up the consensus and do a psychological profile and a scorecard of every analyst. And we find that usually in the US, you might have 50 or 80 analysts covering a single name, but only 4 or 5 of them tend to have a high rate of success in terms of hitting the next earnings. And so we'll focus on those. And of those that are really good, some of them actually are much better at making industry calls. So we'll aggregate their calls across the industry and get an industry level signal. Others are better at picking the earnings when the company is doing well because they're naturally very optimistic, they're perma-bulls. And so they really matter in a constructive environment. And then you have the perma-bears. And so we're going to overweight them when the overall backdrop is negative. And so this gives you an example of what you can do in terms of having a more complicated model, where instead of just taking the consensus, you can find the 5% within the consensus that has a high ability to predict. And then of those, you can go even deeper. And so we'll incorporate that together with insider activity, news flow, litigation, regulatory action. And so we blend all of these things to help us with the timing in terms of entering and exiting position.
Amazing.
You remember Moderna?
Yeah.
So during COVID, I pulled the major holders. There you have large cap funds, mid cap funds, and small cap funds all holding Moderna. Because within your mandate, it always says the manager has to have at least X%, 80 or 90% in this particular segment. So you have this wiggle room.
Yeah.
And now everyone's using their wiggle room to be long NVIDIA.
Yeah.
If you're a European manager,
so
you will try to get something, right?
Yeah.
If you're a staples manager, you're going to use your whatever wiggle room you have.
Yeah.
So all the active managers are heavy to the same names. Yeah. The index is very heavy. And so you have pension plans, sovereign wealth funds, insurance companies, very serious people with very structured investment policies. Yeah. On autopilot, they have arrived in this situation, which if you told them, hey, you should invest like this, they'll say, no, we're very conservative.
It's ironic. It's ironic because the very institutions telling their clients that they need to diversify are falling for the same concentration and deploying capital in the same irresponsible manner as I would my own PA.
Yeah, exactly. So that is the paradox, right? And so what do? I think Apple hit 1 trillion, what was it, like 10 years ago? Yeah. Now you have, for NVIDIA to get from 1 to 3 to 4 trillion, it took and it's because of this. Yeah. That's why it's there, because everyone is holding it. Yeah. And the valuation doesn't matter, right? So that's what I mean. The meaning of a valuation multiple.
Yeah, it's just a multiple. That's all it is. It's an observation. It's barely a metric.
It's an AI trade that people haven't even used a calculator. Yeah. It's just driven by social media, and then that limits the surface area to generate alpha outside of these names. So everyone is over allocated, and the economy is doing well. So you don't want to go to cash. Inflation is high, so the premium on T-bills is very low. So you need to be invested, you need to be engaged, and we're offering a way to get exposure to success and economic development that's outside of the same few names here that everyone is overexposed to. Yeah. So that's my pitch, and I don't know how to say it.
Yeah, no, I think this is a great time. From a macro perspective, we do see more stimulus. We see more monetary easing coming up, at least foreseeable for the next 6 months. It looks like there's good consensus for that. So DXY eventually will weaken a bit, and that's going to drive liquidity into mid-caps is what we're thinking, as well as emerging markets, which are going to be a huge beneficiary. So I think this is a great time to be launching a product like this. So, good luck and congratulations. I do have a question more stepping back. As we have this conversation about how your models in particular, but not just your models, but where we are in the AI space, and the big concern that most industries have is, will this take over my job? And I actually see, as we're discussing this, I'm kind of knocking down, checkboxing and knocking down the different roles in asset management company, from research analyst, intern, execution, now allocation portfolio manager, now CIO. All of that is conceivably, if not partially, taken over by AI to a certain extent, right? And then when we're talking about ranking analysts, I now see more and more analysts not just using AI, perhaps even more AI analysts in the market, where now you have, an AI system, a machine learning system that's now ranking other AI analyst systems in the market to see which one is more accurate. Take a step back as a visionary yourself. Where do you see us going as financiers, as asset managers ourselves? I mean, I know my lawyers are out of a job. I barely use them these days. Are we facing the same death knell at this point?
I think your lawyers will be okay. I mean, 100 years ago, for you to be a successful business person, your calligraphy played a big role because you look more intelligent if you write beautifully. Penmanship now is irrelevant. There used to be then pools of typists who type, and you walk around smoking and dictating. That's gone. Meanwhile, the employment pool is increasing. So, and everyone complains they're working super hard.
Yeah.
So I don't see that going away.
Okay, so let me flip it the other way around, right? Your view is that productivity means that it's going to create more new and interesting, more advanced, high-touch type of jobs. Specifically to asset management, where do you then see the role of the financier and the investment manager in tomorrow's world?
Understanding the clients, and you're looking after clients' life savings, everything they've earned or inherited, and then their future. So that requires a human touch. And then how you translate this into a portfolio. And then the portfolio performance, translating it back to the client and managing their reaction.
Okay, steel manning myself, playing devil's advocate.
Yeah.
You can actually still do that. You can do that now already, right? You can create a chat box LLM that absorbs the information from an interaction with a high net worth or with even a normal client, right? A retail client or even a superannuation client. You inputs, extracts from it the risk tolerance as well as its long-term goals, its objectives, then looks at the background, jurisdiction of the client, and then creates a portfolio, maybe a strategy, and then deploys that without touching human hands. Is arguably possible now. So what comes after that?
It's possible, but when you have a crisis, that's when you need a person. And that's when the portfolio manager or the CIO or the relationship manager is not just an allocator or an analyst, but is a punching bag, right? Or a pillow to cry on, or a shoulder to cry on. And so that, I think, cannot be replaced. So, if you lose 20, 30% of your life savings and you get a chatbot, even if it's made to look like a human, it's not going to retain the accounts. And so I think to win business and keep business, you're still going to need people, because everyone is going to have these humanoid agents appearing and speaking, and the clients will become bored and they will dismiss it. They will see it as fake. And so I think AI can sell to other AI maybe.
I should introduce you to my private banker. He sounds pretty fake these days as well, right? He's so handcuffed by compliance measures and what he can say. If I yell at him, he seems to give me the house view. So there might be some challenge to your point about human speaking.
I think the industry will change. Yeah. Banks will be forced to adapt, and there are going to be a lot of new players. A lot of the tech-driven companies will move into finance. Regulations continue to protect very large institutions, and that will become increasingly under pressure as they will be exposed to be obsolete, unable to cope. Their results will be suboptimal. So if you look at this chart I was telling you in terms of the advancements in compute and the adaptability of the models, that today is the frontier of finance. 3-5 years from now, they'll become table stakes. So if you hold any manager that doesn't use this, you would be putting yourself at a huge disadvantage. And large institutions have a hard time integrating it. We speak to them, and before ChatGPT, they were completely unwilling to listen. Now they're willing to listen, but they're sort of paralyzed in terms of what to do. Their instinct is to build it in-house, but in-house they're very slow and likely to get on the wrong track and then fall farther and farther behind. They're used to competing with banks. They're not used to competing with technology companies. And so that, I think, is going to become a much bigger factor over the next 5 years. So that's where jobs will be lost in one place, but people will have to adapt. Young people are very good at adapting. My son doesn't use Google. He uses ChatGPT for search. And, I was telling him to Google something, and he said, "What's Google?" So the new generation will enter the workforce in very different roles with a very different skill set. And I think they will find employment. For the rest of us, I just see us working longer hours. I'll let you know when I switch to 4 days a week.
Well, thank you very much. And enjoy the rest of your trip at Hong Kong and Asia. And I'll catch up with you in a couple of quarters.
Thank you.
Cheers.